welcome to this event brought to you by the Spectator and Netwealth on the subject of planning for retirement, the road to financial security. I'm Martin Vander Weyer, I'm the business editor of the Spectator, and I'm joined today by two guests who are experts on all of this. Charlotte Ransom, who is the chief executive and founder of Netwealth. Welcome, Charlotte. And Harriet Baldwin, MP. She represents West Worcestershire in the House of Commons. She is a former fund manager herself in the city with JP Morgan in her first career. She has been a minister at the Treasury, economic secretary at the Treasury when George Osborne was Chancellor, and latterly she's a member of the Treasury Select Committee. So Harriet, thank you for joining us. We announced this event, as you'll be aware, as you'll see on the screen, with a nice little graphic of a sort of small family car laden with a large safe on its roof and lots of other luggage and a dog hanging out of the window. And it occurred to me that was a very good image in the sense that we all go through life. We get into middle age with a great jumble of assets and financial commitments without necessarily having kept our car serviced, if I can use that metaphor, all that time, and not necessarily knowing where we're going. So this is an opportunity to sort of clarify a lot of issues about retirement planning and to reassure you, given that we actually have a quite startlingly large audience as far as we know today, and some 1,500 people have signed up to listen to us today. So you're not alone if you're worried about financial planning for your retirement. If you're perhaps in your 50s, let's say, you may be 10 years from retiring, thereabouts, you don't know what to do with the bundle of financial assets and other assets, with all the commitments you have in life, to sort it out for the best for your retirement. We'll hope to throw some light on that today. I'm going to start by asking Charlotte to introduce herself and just give us the flavour of the Netwealth philosophy, just as a starter. Charlotte.
Great, yeah, thank you, Martin, and very good to be here. I actually spent 25 years in the city, had my first career, just as Harriet did, in the city, and 20 of those years at Goldman Sachs, where I was a partner for 10 years. And actually it was when I left the financial services industry and retired effectively at that stage, where I realised that an awful lot could be done to help us as individuals with personal finance. And I think my biggest problem with the industry as it stood was that no one was really taking modern technology and seeing how it could help make these really thorny issues easier to understand, clearer, more transparent. And so the idea behind Netwealth, our philosophy really, is to deliver all the best bits of traditional wealth management, but to use modern technology to make it more flexible, more transparent, and much lower cost, without any compromise on the human element. And by that I mean that most of us really still have moments we want to speak to a human advisor and have that reassurance that we're thinking about things the right way, and we want to know that it's a human who is making the decisions around what to invest in, where my money will be invested. So when it comes to retirement, those sorts of things are absolutely critical. You know, the big questions around when am I going to retire? How long do I expect to be retired for? How much money am I going to need during retirement? Am I going to pass money on to my children before I die, while I'm retired? So, and the way that technology can help bring that alive and sort of help people visualize those different variables is incredibly helpful. And hopefully today we'll cover some of this to sort of try and, you know, pull away the sort of mystery and make it rather simpler for people to think about.
Great, okay. And Harriet, there are obviously sort of two strands of conversation we can pursue. One is about what can the professionals do to help and what decisions can you make for yourself. The other is what can the government do to make things better or worse for you? What are the key public policy issues currently on your agenda or coming up that also need to be considered? Now, you've gone from being a practitioner to being in politics. Just kick that one around for us for a moment.
Thank you very much, Martin. Yes, my days as a professional investment manager are long behind me. And now I think I can bring most relevance to today's discussion by talking from my perch on the Treasury Select Committee, where we scrutinise the work of the Bank of England, where we scrutinise the work of the Treasury, and look at the ways in which the public policy goals that every government seems to seek to want to achieve are being implemented. And first among those, and I'm sure we'll get onto it, is the Bank of England's remit in terms of keeping inflation low. I'm sure you'll want to talk about, the public policy issues around pensions generally. We've tried to encourage people to save more for their retirement through a number of different interventions, whether it's through the tax system, but also really importantly through auto-enrolment, which has taken the number of savers for pensions in the UK economy up from 1 million up to 10 million. So it's had a huge impact in terms of future saving, probably still not saving enough, but that's been an important public policy intervention. And then obviously there's the stuff right nearest to us in terms of the cost of living and how dramatic that is, particularly for existing pensioners who are on a fixed income.
Yeah, well, let's go straight into that because it's the most topical theme we can cover today, and lots of people have already asked us questions about it. We could say a couple of years ago retirement planning might have looked rather smoother than it looks today, and suddenly we're hit by a surge in inflation and quite a change of financial circumstance, a lot of uncertainty in the air right now. Charlotte, how much does that change the basic questions like when do I retire? How much do I need to retire? I can throw some more questions, but just start in on cost of living crisis. What does that do to all of this?
I mean, you're quite right that the environment has changed really quite dramatically recently over the last couple of years. And actually, the truth is we've had an unbelievably benign environment, whether inflation or growth, over the last 30 years. And so we've all got rather used to a situation where it's been simpler to think about how to, how much we're going to need in retirement and how we're going to fund it. At the moment, we have a very difficult inflationary backdrop, as we know, and that is actually being coupled with real concerns about growth. And so we've got, central banks now talking about needing to raise rates quite aggressively. We're seeing China locking down with, further concerns about the pandemic, which is affecting their growth. We have real sort of consumer issues in the UK, as you know. We also have inflation shocks in the US, and all of that's contributing to a much more difficult overall growth environment, clearly impacted as well by higher inflation. What I think is fascinating is that the market, the way it's reacting, is it's saying basically it can't imagine that the central banks can raise rates aggressively. And that's interesting when you think that actually the 10-year government bonds in the US are only at 3%. In the UK, they're at 2%. In Germany, they're 1%. So in fact, the risk-free rate, as we talk about, is remarkably low. But there's a sense that the economies are really going to need some help in sustaining reasonable levels of growth. Now, when it comes to planning for retirement, as you say, this can really have a dramatic impact. One of the things I was looking at is when I talked about the tools we use to help people understand how they might think about what they need in order to retire. I was thinking about, as you said earlier, maybe you're in your mid-50s, so you're 55, you might want to retire, say, at 65, and you might want that retirement to last until you're 90. So often people underestimate, that's the other thing, how long they need the money to last. So let's say they're looking for it to last 25 years. Well, if inflation were trotting along at the sort of 2% that we've all got used to, then in fact, if you were to fund that with an £800,000 pot, and over the next 10 years before you retire, put in annual amounts of, say, £10,000 a year, then you could expect that pot to give you roughly £50,000 income per annum during that 25-year period I was talking about. If inflation's at 4% on average, then suddenly that pot reduces down by 6 years. So all of a sudden now at 84, the pot runs out. So what can you do about that? Well, obviously, one thing you can do is take a lower income. And in fact, if you were to change the income requirements down from 50,000 to, say, more like 35, 36, that would do it. So you can see, though, there's quite a dramatic impact from what sounds like a relatively small change in inflation. I think the thing that we have to remember is that inflation won't stay at these very elevated levels for a long time, and growth will also change over time as well. And the thing that perhaps people forget when they start thinking about retirement is they think about retirement as a moment as opposed to multiple decades. So actually, for this 55-year-old we've just been talking about, they are talking about from now until they're 90. So there's a long period during which time there will be, the markets will go up and they'll go down. Inflation will, right now it's high, it'll come back down again. And it's important to stay sort of connected with the variables that you can change to make sure that over that period you are servicing, your needs.
Okay. And so, simple question: if we're looking at, say, a 3-year surge in the cost of living, but we believe the IMF, the Bank of England, whoever it may be, telling us that inflation will calm down in due course. If you had the choice to go on working through that surge period rather than taking retirement now, you enjoy your job, you might like to go on working. Is it sensible to go on working through the cost of living surge? Then revisit your planning. Secondly, if you had a choice between taking lump sum out of your pension arrangements or a higher income, how would you address that in terms of the inflation surge?
Okay, so two quite different questions.
Two different questions,
And I would say if you are willing and able to continue working, if there is this sort of significant surge in cost of living, then it would tend to make sense to continue to have that income coming in. I mean, if you have the choice and you're willing and able, why not? I think that generally speaking, people will not tend to have that much flexibility around when they want to retire. There'll be a moment that is a trigger for them when this is the point. They may, though, for example, because we're now able to work from home, we're able to work more flexibly. Actually, I think this whole point of when retirement even begins is more of a moot point, and there is more flexibility about how it might look. The second question, in terms of taking this lump sum, I mean, first of all, just to be clear, we all have access to 25% of our pensions tax-free. And we can take it when we retire. We can take it several years later. We can take it all in one go. We can take it in increments. There's a great deal of flexibility about what we do with that tax-free lump sum. And I think a lot of it will have to do with individual circumstances. So at the moment, pensions remain a very useful tool for inheritance tax planning because your entire pension falls outside of your estate from an inheritance tax perspective. Therefore, if you don't need to touch your pension because you have other assets at your disposal, then you probably won't take the lump sum and you will allow your pension to continue to grow in whatever form it's invested. However, if you have, for example, a mortgage to pay off, or you're thinking about buying, something for your dependents, a house or flats or whatever, then there may well be a reason that you decide to take out the lump sum. And quite often, we tend to advise that taking it all at once tends to work out economically more to be better than taking it out in increments. But it definitely depends on individual scenarios. The reasons I say better is partly because there are costs quite often to each time you take some money out.
So that decision is really driven by personal circumstances more than wider economic issues.
I would say so. I think actually a lot of the discussion today, although we're all like a bit of a rabbit in headlights in terms of this sort of massive number that the press keep telling us about, and it does make a difference as we talked about, I think actually it will still boil down to really quite personal choices and personal situations.
Yeah. Yes, Harriet, I think I read or heard that all the cabinet members had been told to go away and come back with one idea each to ease the cost of living crisis, but particularly for people on the cusp of retirement. Actually, can the government do anything very much at the moment? They can't really bring fuel bills down. What else could they do?
Well, two public policy things. We've tried to strengthen the sort of foundation of people's retirement, which is the state pension, and we've tried to make that better over the years. We got confirmation recently in the Treasury Select Committee from the Chancellor that he would apply the triple lock again, and that would be to September's inflation. And currently what's expected about then is around 7.4%. So the state pension, he has confirmed, will go up by 7.4%. So I think that's one of the sort of foundation blocks for people's retirement planning, which is important. But Charlotte, made me think about, some of the other public policy issues around pensions. And I stress this is not something that the current government would ever think about, but this 25% tax-free lump sum, it is a huge incentive for people to save into a pension. And it's not impossible that future chancellors, might look at the whole way in which pension taxation incentivise pension saving, and they might make future changes to it. So that would be another factor to take into account, I think, if you're looking at your retirement planning in the whole. You mentioned the cost of living, energy prices, and of course they are set in world markets. The Chancellor's announced some very significant sized support, something like £9 billion worth of assistance to people, often in the form of a cash grant if you're in a council tax A to D, but also, of course, 5p off the cost of fuel, which is not cheap to do.
Okay. Well, we're not in a party political broadcast, so we won't go into too much of that. But there's also, I think, there's an issue around the total size of the pension pot and the cap on that, isn't there? Am I right that the present Chancellor has capped that, and in these circumstances of inflation, people of sort of higher income might well feel they'd like to have a bigger pension pot, but they can't. Is it just?
Well, yes, so you're talking about the lifetime allowance. In 2006, there was this concept of the total amount that you can build into your pension would be capped. And at its height, it was 1.8 million. And then over time, that cap has come down, and now it's just over £1 million. And although £1 million sounds like a lot, actually, with a lifetime of saving, you could easily expect to be at £1 million. Above that number, you are taxed at a penal rate of 55%. So there's a lot of fixation around this 55% number. I would say that actually there are various things to think about in the context of this saving into your pension and why it can still make sense. First of all, that there is a significant pool of money that is tax-free, as we talked about. You'll be taxed at your marginal rate when you draw from it, and it is only the amount over and above the cap that you pay this higher rate on. But that's as and when and if you draw from it. So largely speaking, as we said, we would recommend to people that they do think about, if they're going to tap into their pension, that they, because as we said, otherwise you might keep it as an inheritance tax planning tool. But if you're going to tap into it, take that tax-free lump sum. In doing so, you're able to do what you want with that, which if you don't have something necessarily planned for it, you can put it into ISAs, which are obviously tax efficient, and you can even put it into a taxable account but still make use of dividend and capital gains tax allowances that everyone has every year. But with the remainder, so let's say we have £1 million pension and we're worried about that lifetime allowance and going through it. The remainder, therefore, is a smaller amount, £750,000 left, on which to be able to earn those returns that may take you above the lifetime allowance, but not by that much. And I think really the point is that people must and should save into their pensions to make sure they get to the cap at least, and then probably, in truth, it'll be a relatively marginal amount that they're thinking about over and above that on which they pay the higher rate.
I mean, is there some politics in that, Harriet, in the sense that, £1 million looks like a big number, but it isn't? That's what Charlotte's really saying. We're talking about how to secure for yourself an income of £35,000 to £40,000 for the rest of your life. But to do that, you need 800, a million, and so on. These are not as big numbers as they look, but in presentational terms, that's an easy win to put put a cap on. Is that a too
Well, I think-
superficial a view?
You know, from a public policy point of view, actually what we really want to achieve is for the vast majority of the population who never come anywhere near £1 million in terms of pension savings to save more and to have a more secure retirement. So that will be the public policy sort of central objective. But I think where we have found this policy cuts across in terms of the public sector is in some of the very highly paid people in the public sector who've got these, rare things these days, these defined benefit pension schemes, and are often, retiring earlier as a result. Particularly, it's been a political issue for, hospital consultants and people who are very senior in the NHS, because obviously we all want to have as many doctors and nurses as possible in the NHS. So that's been an issue where I've noticed the Chancellor's had to do some tweaking around the edges.
And we can't tell whether the civil servants have retired or not because they're all working from home. Is that right?
Despite
Despite Mr. Rees-Mogg's efforts to get them back. Yeah. Yes, and you say, of course, the vast majority of people would never get to these kind of 6-7 figure savings pots. But of course, a very large number of people own a property, which towards the end of their life is probably maybe unmortgaged or with a small residual mortgage on it and so on. That leads us towards a sort of general view of the whole asset portfolio, really. Charlotte, talk a little bit about how people should think of that as between the physical property they own, the financial assets. Are there inflation-proof investments they should be rushing to buy right now? If you have a big house, is downsizing the obvious thing to do to get your asset portfolio in line with your aspirations for the rest of your life, as it were?
Very interesting question. I mean, the vast majority of our clients have substantial holdings in property, largely because, like so many people, property has just gone up so much over the last couple of decades that whether you plan to or not, it is a significant part of one's overall wealth. Even more true if over time you've built up a rental property portfolio as well. Over and above that, we strongly recommend that people have investment portfolios that are globally diversified so that they are earning investment returns as well as thinking about this, chunk of value that's sitting in property. Property is often considered to be a great sort of hedge against inflation. But, I think it sort of depends a bit what type of inflation are you talking about. So, inflation that's led just by growth can be a good thing and can help property prices. But inflation that is partly driven by a series of crises, which is what we're living through right now, is not necessarily going to be good for inflation, for property. I mean, actually, so far the property market has held up, but I think there are concerns around just where demand is going to go at this stage, given all of the different costs that we're having to factor into daily living now. So I think you have to be very thoughtful about the makeup of your retirement portfolio, because of course one thing about property is that it's illiquid, it's high friction costs, so it's quite expensive to get in and out of, and it's not going to throw off cash flows unless it's a buy-to-let type of property because you're living in it. Your question as to whether you should downsize, I think, is very interesting because right now, and Harriet, I know, will have a view on this, right now it's capital gains free if it's your primary residence. And I think for many of us, you would feel pretty mortified if you are living in a 6-bedroom house and there's a 4-bedroom house, there's only 2 of you left now, say, you don't downsize, and then at some stage there's a change to taxation and you end up paying 28% or somewhere between 18 and 28% on your primary residence that previously all of those gains were tax-free. So I think you want to think about your property in that context. I think then you really want to have investment assets that are diversified so that now the difference being they tend to be liquid, therefore you can get in and out relatively easily, they throw off returns, and you can customize cash flows the way that you can't necessarily from your property. And then at the other end of the extreme, there may be other sort of fun things that you enjoy investing in. There's lots of chat about crypto, for example, these days. That's not something I would necessarily recommend, but people will have things they enjoy buying and investing in that, you know, may just add to that overall portfolio that they hold.
Let's come back to those wider asset choices. Let's
Okay.
just stick with property for a second. So suppose I decide on downsizing from my family size house to something that would suit a retired couple with occasional guests. That releases some cash, clearly. One choice for that cash would be a buy-to-let property. So 2 questions for our politician panelist, as it were. One is there any risk that the tax advantage of your, no capital gains tax on your principal home, is that at risk in any way? Secondly, the government doesn't take a particularly friendly view of the buy-to-let market. Is that going to get tougher, or might it get easier going forward?
Yeah, great questions there. I mean, I think of politics in terms of, the electric third rail in politics. I would have thought that taxing the capital gain on your primary residence would be the kind of electric third rail that no politician would ever go near, I would hope. But, certainly it's, wise of Charlotte to highlight it. Because, every budget, when the Chancellor stands at the dispatch box, only he knows, or so far it's always been he, what they're going to announce. And I think that on the second question around, buy-to-let, I remember from my old days as an investment manager that there's really only one free lunch in investing, and that's diversification, isn't it? Not putting all your eggs into the same basket. And so there's wisdom in what Charlotte was saying about a broadly diversified global portfolio of different things rather than all being UK property, which has done well, there's no question about it. And then buy-to-let also raises political issues because you get parts of the country where they have a huge number of second home owners, and I'm thinking of the Lake District of Cornwall and so on, where I hear my colleagues who represent those parts of the world raising this as a huge issue for their local population who find they can't get on the housing ladder. And all politicians want everyone to be able to get on the housing ladder and work towards owning their own home. That's a very common ground in politics. So I think there's probably much greater risk in terms of change around the buy-to-let taxation than there might be around the primary residence.
And quite understandably, the first-time buyer and the access to the housing ladder is a more important political issue than the rights or benefits accruing to buy-to-let investors. That's understandable, isn't it?
Yeah,
Sorry,
maybe
Charlotte.
just one thing to add actually to the point about buy-to-lets, because it is a very frequent question from a certain demographic as to, as you say, do I downsize and then do I take that extra cash and buy a buy-to-let? Instead of, often, putting more into my pension or adding to my ISAs. And actually, we do this break-even analysis all the time. And for the tax wrappers, the tax-enhanced investment products, it is easily makes more sense to be invested in them and add your pensions, add your ISAs, assuming a sort of, generally positive growth of sort of 4 or 5% per annum versus buy-to-let. And even in a taxable portfolio, so a general investment account, actually the break-even is about 10 years. So in other words, you need to buy that house or flat, own it for 10 years, get the income. And it's only at that point, beyond that, assuming everything else stays stable, that you are better off having the buy-to-let because of the as Harriet's saying, the gradual changes to make that a somewhat less attractive investment vehicle. So I think it's a really important thing for people to understand, because we have this, I think we can't help ourselves. We have this feeling that property is somehow, I can touch it, I can feel it, I can live in it if I want to. And it somehow feels safer and possibly better because it's better.
To understand.
Easier to understand.
And it doesn't get mark to market every day, so that you don't get those sort of worries when the markets fall.
Okay.
Yeah.
But again, the arithmetic needs to work. Yeah, I just want to say it's a great pleasure that so many people have logged on to watch us. You are very welcome to ask questions, and we'll devote the last 20 minutes or so of the show to the questions that have come in. So by all means, do put them into the chat box, and I will take some of your questions as soon as I can. But let's meanwhile go a little further into this sort of asset allocation question. A lot of people asked us in the preliminary questions, is there a right allocation between UK-based assets, equities, gilts and so on, and global assets, emerging market assets. I'm often surprised. I mean, when I look at my own sort of managed portfolio of savings, but also I sit on a couple of investment committees, I'm often surprised how little is invested in the UK in those kind of funds. How do you analyse that for a retiree who's basically going to live in this country? It's different if I was going to go and live in a little flat in the south of Spain or something. I might need a different currency base. But if I'm basically a UK retiree wanting a secure income, why do I need a load of overseas investments in my portfolio?
It really comes down to this point of diversification that Harriet was raising. And to give you a sense, so for a 60-40 portfolio, which I would consider to be pretty classic for a retiree, meaning 60% in the equity market, 40% in fixed income, of that overall exposure in the equity markets, right now at Netwealth, our portfolio would be roughly 20% US, 20% UK, 10% Asia, 10% emerging markets, 5% Europe, and some commodities and gold. Now, what I would stress, though, is that the currency exposure doesn't line up with that. So it's not that there's only 20% sterling exposure, 20% dollar exposure, because that is where I think you have to be very careful as an investor. If you are British, living in England, main liabilities in pound sterling, you don't want significant quantities of foreign exchange exposure. And you might want somebody else, to the extent there is foreign exchange exposure, to be managing that for you. So for the 60-40 portfolio I just described, it would actually have about 60% sterling exposure, and then 40% we would manage the foreign exchange exposure, which we believe to be beneficial to the UK investor. And I'll give you a reason, sort of current reason why that might be the case. As you've probably seen, sterling has taken a bit of a battering recently for lots of reasons. The US dollar has done very well. And then just very interestingly, as this debate around global growth has sort of quickened and the volume has gone up, the Japanese yen has started to do very well again. And again, that is a typical sort of safe haven for people to be in. So as an individual investor, I would be unlikely to rush out and buy Japanese yen. I want someone doing that for me, so that I know that I've got the right sort of currency mix, as well as the right sort of country mix, if you like, that we were just discussing.
And a lot of people don't really spot the fact that many of the FTSE 100 blue chip companies, which you might think of as UK assets, are in fact global businesses whose business is much more affected by the level of the dollar especially. So you have to sort of be able to see through that, or your advisor needs to make it very transparent to you. So that takes me to another question, which is it better, easier, better for the customer to see a portfolio of individual stocks, or is it just much more sophisticated to buy into fund products and fund of fund products and these computer-generated portfolios, which may be difficult to understand, but on the other hand, they are a more subtle form of investment vehicle altogether. And if you just pick 10 or 20 stocks, you're taking a different set of risks, if you follow my question. How do you analyse that one?
Well, I think concentrated stock portfolios, which is, typically if you're talking about 10 stocks, that would be considered really quite concentrated. Yeah. And that is, there are many professionals who have spent an entire career trying to do that well and have very often failed. So as a rule, active managers have tended to be unable to outperform net of their fees, whatever is the benchmark they're trying to outperform. Now, there are obviously, luckily, some groups for whom that's not true. So take Scottish Mortgage Trust, for example, or take Fundsmith. These are groups that have done well, that are concentrated stock pickers. But take Scottish Mortgage Trust, and actually it is half the value today that it was last November. So there are, as you would expect, much more significant swings when you take concentrated bets, which is why one of the things we absolutely advocate is that for the core of your holdings, what I would suggest is that people go for what I call sleep well returns. So trying to drive returns that are inflation plus a bit or a bit more, depending on how much risk you want, that match up with your overall financial goals. And then the concentrated funds, the ones that are, maybe you want to invest in yourself, or, there are managers whom you like and you trust, put some of your money in that, where you might get ginormous returns, or you might get, relatively ginormous losses, but on a relatively small proportion of your overall wealth. And I think that lines up quite well versus, the property, the more sort of flexible, globally diversified, low-cost core of your investments, and then potentially the concentrated portfolio as well. But I think people need to understand that it is much more risky buying into those very concentrated portfolios.
Yes, Scottish Mortgage Trust, for example, actually is a picker of tech stocks, a lot of US tech stocks. That's
yes, and they've done brilliantly well for a long time.
Nothing much to do with Scotland or mortgages, but
No.
but it has been great, and then took a great dive, didn't it? And Fundsmith depends on how much faith you would have in an individual fund manager. I mean, from a supervisory view, Treasury Select Committee view of the industry now, the wealth management industry and so on, do you have big worries that there's too much slick salesmanship, too much complexity? I mean, the problem of too many hidden fees has been a little bit unravelled, hasn't it? But what are your worries as an overseer?
Yeah, I think you have touched on a really good topic there, Martin, which is the fees that the industry charges, often for index-like investing, is one of my pet peeves and bugbears. And I do think that there obviously are. It's a great strength in the United Kingdom. We've got some fantastic active investment managers located in the UK, and people can take advantage of them. But it is really a full-time job figuring out who they are and keeping on top of what they're doing. And similarly, if you're doing your own personal portfolio, you're not going to have that edge that some of the professionals have in terms of access to the investor meetings and so on. So I think that for the ordinary investor, really a diversified, broadly invested group of funds, ones that have low fees, for me, is something that, from a policy point of view, is something we should incentivise. I think that the fees that can be charged for, very, very average products, when you consider how low rates of return are, actually one of the most sensible things you can do as a retail investor is look for someone who's not going to charge you a huge amount for your portfolio.
Can I add to that? Because as you know, Martin, I have a very, very strong view on this, and it's really why I started Netwealth. Because fees can make such a colossal difference. I mean, we actually had a client who came in and was specifically talking about his retirement, and he was moving his reasonably significant pension from somewhere else to us. And we showed him that he, in his case, would be saving 1% per annum in fees. And the difference to his pension pot was that he was able to earn an additional 7 years on a 30-year retirement pot. Wow. So just as a proportion, if you think 23 years versus 30, that you paying an extra 1% in fees per annum results in that sort of difference to your retirement is absolutely mind-blowing. And I think it is something which is actually very difficult often for people to actually know how much they're paying. So Harriet mentioned fees. We're all talking about fees, but what are these fees? What are you even meant to ask? And actually what happened is the regulator had to impose a new law that is called MiFID II that requires a wealth manager now to put into your report what their actual fees are, broken down by not just their management fee, but how much of the funds that they're managing underneath that, what are the transaction costs, what are the advice fees, and what is therefore the total cost. And even with that, so first of all, it's slightly remarkable that you have to have a new law to say to people you should really tell them how much you're charging. Outrageous. And second of all, I've talked to endless people who can't actually get even to the page where that now is meant to be spelled out. And when it is spelled out, it's not spelled out in a way which is necessarily that easy to understand. So I would say the minimum that we see people save when they move to Netwealth is 1% per annum. But we found people who are saving 2% per annum. And it is absolutely critical to the difference it makes to retirement planning and to financial futures.
That takes me to, well, one of the questions that have come in from the audience. Roger has asked us a question. Finding a trusted advisor to provide just advice is hard, rather than paying the set fee on assets under management. So what use is an IFA? Is an IFA someone you should consult at the beginning of your retirement planning, and when you've got it in place, you don't need to pay separately for that advice? You need products as well as advice. Where does the IFA come in? How do you know you've got a good one?
Well, that is a very interesting question because this is an unbelievably fragmented industry, meaning there are huge numbers of IFAs across Britain, and personal finance is a topic which lots of people find quite difficult to get to grips with. And so they end up getting themselves into a situation sometimes where they think they've got a friend who is helping advise them, with what they need to do. But that friend is actually taking quite a lot of money off the table for themselves. So when you assess whether or not this is the type of person you want to work with, I think you need, first of all, to be sure, are they asking the right questions in terms of really trying to understand what you're trying to achieve? What are your financial goals? They're not trying to sell you product or not even indeed their service, but they're listening to what it is you want. And they are completely clear when you ask them how their costs work, which if you ever feel someone isn't being clear, they're almost definitely not, and there will be other things going on. The question about advice, though, is a very interesting one, because I think that we will all probably have moments in our life when advice is necessary. So retirement is a classic one. As you run up to retirement, or possibly you've just started, it's a good time to have a sort of mark to market and say, okay, am I in a good position now to think about retiring? Have I got what I need, and so on? There may be other moments. It might be a divorce. It might be an inheritance. It might be another sort of liquidity event. It might be that you want to start thinking about giving money to your adult children, and you want somebody to help you think through, have I got enough for my retirement, and how much can I give to my children, and in what sort of periods? So the way that Netwealth charges for advice actually is, if people want to take advice annually, they can, in which case we charge 0.2%. But actually more people take it one-off. So you pay by the hour. And actually I really think that, generally speaking, people need that choice, because you will have people who feel comforted by annual advice. But for most of us, you don't necessarily need it every year. And there are these one-off moments when it's super helpful. And actually, I think that is where the financial services industry does come into its own, that actually the real value you can get is with good advice. Because if you get good advice, it will really help you think about, in your retirement, how best to save for what you're trying to do, and actually, importantly as well, where to draw from, which pots to draw from in the most tax-efficient way. So there's lots to be said for advice, but it is, generally speaking, overcharged for, and
Harriet, your view on the IFA sector, or where else to go for good advice?
I think, when I was Economic Secretary, I did something called the Financial Advice Market Review to see where the big problems and gaps were from a public policy point of view. And one of the things that we've put a lot of emphasis on since then has been the free access to guidance, so not advice, called PensionWise, which is out there and which anyone can consult and get an appointment free of charge for that guidance. Now, one of the things that you may get as a result of that guidance is, now would be a good time to go and see a financial advisor. And then, obviously, I think you want to look at the range of different ways in which the internet is disrupting this space, as well as who might be good locally and word of mouth. So I think I wouldn't add anything to what Charlotte has said, except that I would say to people listening that if you think you want to try to get some guidance, then PensionWise is the one that the government provides, and I think has had some good feedback, but not enough people are using it.
And we might say that the wise friend you need at certain points, decisions about inheritance, gifts and so on, may not be an IFA. It may be the family solicitor, the wise old family friend, and so on. Let's take a couple more questions from the audience. Here's a rather technical one. Charlotte, what role could equity release play in retirement planning? Mark asks us this one. Equity release?
Yes. I mean, this is where you're able to take the value of your property and to, basically earn a pot of money based on the value of your house that then, in the event that you die, the property value will be paid back to the person that you've effectively borrowed from. We tend to see relatively little of it among our clients, so we don't spend a lot of time advising on it. I think that it's one of those tools which is good to know is available. I think it is very important, though, whenever you're borrowing money, to think quite hard about what is the charge effectively? What is it costing you? Because it's all very well to say, well, once I die, I don't have to worry about it, but it may well be your children's problem. So I'm a little bit sceptical. Having said that, I can certainly see in some people's cases it's the right thing to do.
It could. I mean, this may be an unfair thing to say. Harriet, tell me if I'm right. It's the sort of device that could smack of mis-selling or hard selling. One imagines the equity release salesman sort of going from door to door.
Yes,
and it's slightly uncomfortable.
Slightly uncomfortable. And also, as a constituency MP, I have had some horror stories come through my casework. So I would ask people to think long and hard, and also ask questions about what interest rate they would be paying and compounding at when they look at equity release.
Something to be very careful about.
Yeah, I mean, generally speaking, anything that sounds too good to be true is too good to be true. And anything that is suggesting it can return multiples of the risk-free rate is by definition going to have deep embedded risk in it. So, we've seen these mis-selling problems in the past, and I'm sure there will be, hopefully fewer, but nevertheless the same sorts of problems in the future. And it's just worth remembering, Harriet mentioned this notion of a free lunch, and there being no free lunch bar diversification. I would say it kind of goes back to those things of what are the things you can control versus what are the things you can't control, and really trying to focus on those bits that you can. So don't sit with piles of cash. Do make sure you know exactly how much you're paying someone in fees and whether it's the right thing to do. Do be diversified. There are things that are within our control. What's outside is, when am I going to die? Are the markets going to go up or down? Where's inflation going? And those are more things that you can model for rather than control.
Yeah. One more rather technical one. This is from Julian. Can Charlotte comment on salary sacrifice for additional voluntary contributions for those on modest salaries?
Well, actually, I think this might be one for Harriet more than for me.
Well, I would say that one of the biggest tax breaks you have in this country is that allows you to save for your pension, and basically saying forfeit the salary now because you will have a stronger salary when you retire. And I think that's the behaviour that it's intended to drive, and anyone who can afford to put more into their pension, I would always suggest that they put more into their pension.
Good. Good. A question from David. If you have accumulated pensions from different workplaces, is it best to consolidate them or leave them separate? Now, there are sellers of that service that advertise quite heavily.
Yes.
Is it a good thing?
Well, yes, is my answer. And the reason for that is it's very interesting. It's more and more common for people to have now multiple places of work. So, several generations ago, someone might have stayed in one place for life. Now that's no longer the case. And so lots of people will have 2, 3, 4, maybe more pension pots. And each one of those individual pots might not be that big in and of itself, but in total they amount to quite a lot. And what happens when you have different pots in different places, you lose sight of what are they invested in, how much am I paying to have them invested, have I made any decisions about do I like what they're invested in, and you can even lose the pension itself, which I think is also a problem of people not even knowing where it is. So the other reason why it tends still to be the case that people have these disparate pensions is because the industry, meaning the financial services industry, has tended to make it quite difficult to move it. So you may need to know passwords, you may need to have information you don't feel you can easily get hold of. And so one of the things we do, and there are others who try to do this as well, is if someone comes to us and says, okay, I've got these 4 different pensions from this group or these groups, these are my policy numbers, that's all we need to know. And the team actually will then go and sort of retrieve them all, if you like, and put them into one place. And the last thing I'll say about the reason why it matters so much is because, as I said at the outset, retirement is a long-term thing. So if you don't have your eye on where's it invested, how much are you paying, and so on, you know, I went back to this example of people paying at least 1% more than they should in fees. That's not just for a year, that might be for 30 years. And as a rule of thumb, by the way, for every 10 years you overpay 1%, that costs 14% of your capital. Wow. So on £100,000, that's 14,000 you're giving away. So it actually matters a lot to be, I think, to bring this together and really make sure you're making the most of that value. So
we shouldn't confuse, so that pension consolidation and the mechanisms for that are now well recognised, and you're saying that has a clear advantage, and we shouldn't confuse that with the previous era of mis-selling of personal pensions, when people sometimes put their pension pot from their employer into a personal pension, and they were ripped off basically very, very often.
Yeah, well, so now SIPs, self-invested personal pensions, are the absolute norm, and a SIP is just a wrapper. You know, so you can take your SIP and do with it what you want. It doesn't sort of belong to a specific group.
And Martin, if I may on this, again, from a public policy point of view, we've been passing legislation that enables pensions dashboards. So just as people have got used to open banking where you can see more than one bank account with your existing bank, pensions dashboards will allow you to look across all your different pensions, because in fact I was startled to learn that the average person in the UK now will work for 11 different employers in their lifetime.
Wow. So I'm going to fire a question at you, Harriet. We've obviously been talking about retirement planning largely for middle-class folk who are not too badly off here. But Shmuel asks us, what's your solution to financial security for retired people from low socio-economic groups? So, you know, just for a moment, let's address people who haven't got the £500,000 pot, or much, much smaller. They might own their house. That may be their only substantial asset. Where do you start?
Well, I think, again, go back to the state pension and the strengthening that we've put in place with the state pension. I know that over the 3-year time horizon, it will have been triple locked, and it will have protected against these rises in inflation that we've seen for people who are relying on that basic state pension. The other thing I would really like to get out as a very strong message is there are so many people in this country, I think it's 850,000 people on low incomes who are entitled to pension credit, who do not actually register for pension credit. So there's money just sitting there for them that they're not asking for. So I would recommend people do a benefits check to see if there are benefits they could be accessing. Obviously, as you get older, you or get the money in terms of your heating allowance. That's very important. But also in your local authority, they may have a discretionary fund that can help you, that is perhaps administered as in my area by the Citizens Advice. So there are a range of different schemes that do help people on low incomes. But my central message would be about making sure you're claiming that pension credit you're entitled to.
And should you go to the Citizens Advice Bureau? Should your constituent come to your surgery to get the detail of those things?
Either would be fine, and there are some quite good benefit checkers on the DWP website, like Turn to Us and things like that, which will allow you to put in your details and will give you some signposting.
Yeah, I'm sure it's all there online somewhere.
Oh, I know.
So
well,
many,
then go and see your friendly local
have a
MP.
trusted person sitting in front of them, telling them. We've got 6 or 7 minutes left. We'll do 1 or 2 more quick questions. So, Charlotte, any comment? David asks on splitting money with one's spouse. assuming you're staying married. That
yes.
is. Yeah.
So actually, that's a very good question, because one of the things we've talked a little bit about today is that there are definite tax allowances that we should all be taking advantage of. So pensions, ISAs, the two probably most important ones. And often we find that people haven't thought that if their spouse hasn't maxed out on those areas, that they should contribute into them as well. So assuming you're intending to remain married, which is, always positive, it is definitely worth making sure that if you have a non-working spouse or somebody who's stopped working, for whatever reason, that you are helping max out on their pension. Same to max out on their ISAs. And then I would say the other thing to think about is, even if you want to keep your finances separate, which is what some couples choose to do and is completely understandable, it is worth thinking about, if you're going to have financial advice or you're going to have your money managed by somebody, to think about that together, even though you may remain two independent clients. Because you will, certainly in our case, we have something called the Netwealth network, and you build economies of scale across a family, or across actually friends if you want, which allows you then to all benefit from lower fees. So, I think the spousal awareness of how you can make the most of the family unit is a very important thing to think about.
And really important to highlight that to get your full state pension, you need those 30 years of stamp effectively, and that the years that you take out, if you do, for childcare can be added back in. And so it's really important for women, but who tend to be predominantly people who do this, that they make sure that they've accrued all those years so that they get the full state pension when they retire.
And do you have any sort of rule of thumb about when people should pass assets to their children, other than on death, as it were? Or is that entirely a matter of personal circumstances and family circumstances?
It has a lot to do with family circumstances, but the one cardinal rule is, first of all, work out how much you need. So the worst possible situation is where you have passed money on to your children and you have misjudged how much you're going to need. The last thing you want is to be asking them for it back. So the first thing is to work out how much you need. And for example, with today's topic, to do that in the context of, what if inflation does this? What if growth does that? What if I live 5 years longer than I'm expecting? Think about those what ifs, work out how much you need. And then I think there's a lot to be said for starting to think about passing money on before you die. Partly you get the enjoyment of seeing, let's say your young adult children now have a nicer place to live, or, they're able to
get them out of the house.
Get them out of your house, educate your grandchildren, whatever it might be. And from an inheritance tax planning perspective, it starts the 7-year clock ticking as well. So there are reasons why it's quite nice to start that giving before you die, and then having it on death.
And if you have a little spare cash, a quick last question really, and the things you might think of as more speculative or more fun, the crypto, gold bars, fine wine, old masters paintings, those kind of things, do they come into your spectrum of advice, or do you say do that if you like, but that's not for...
Okay, well, I'm going to give you a very whirlwind tour of what I call the three-pot theory. Okay, so we all have three pots.
It used to be a whirlwind as time is against
It's
us
whirlwind.
now,
So we all, roughly speaking, have 3 pots. Pot 1, liquid stuff. Cash comes in, salary, rental income, dividends, whatever. Out of that, all the fun stuff you like to do, restaurants, theatre, living. More than used to right now. Pot 3 is what I call... It's the illiquid pot. It's got your house in it. It might have the fundsmiths or the sort of fund managers we were talking about, and it might have things like crypto. It might have fine wine, vintage cars, whatever. So I sometimes call it the passion pot. And as investors, that's the pot we actually quite enjoy. Pot 2, the pot 2 in the middle, is where you drive, core sleep well returns, and that's where a group like Netwealth comes in, doing the bits you don't enjoy as much, but making sure you have that in a low-cost, flexible format. And then actually you can get flows that go from 2 into 1 if you need to top up your cash, or from 2 into 3 if you find another passion. So if you're dead set on crypto, you could do a little bit in your passion pot, but I definitely wouldn't make it a core part of your overall investing.
Okay. Harriet, do you want to tell us what's in your passion pot?
Oh dear. Well, art.
Or give us any other final 30 seconds of your good
husband,
advice.
My husband collects railway memorabilia, so he's the world-leading expert on the Flying Scotsman, which has its centenary next year.
There we are. So a very last word for a few seconds, Charlotte, if you'd like to.
I think my parting words to your long-suffering audience who's listened to an hour of us telling everyone how difficult it all is to go back to this concept of control the controllables. And if you do that, you will end up feeling a lot more secure about your retirement.
Yeah. So there we are. Work out what you need by way of income, work out how you can make that last the rest of your life, and sleep well. I think that's our advice. Anyway, it's been a pleasure for me to talk to Harriet and Charlotte this morning. I hope you have gained some useful information from it, and I hope you'll all join us again when we do this next time. So thank you very much indeed. Thank you for being with us, and good afternoon. Thank you. Goodbye.